Ladies and gentlemen, we are standing on the brink of a financial shift that occurs perhaps once every decade, sometimes even less frequently. If you're not prepared, you risk missing out on one of the most critical periods in the market. This isn't just another market cycle, and what happens next could define your financial future. Your strategy and your mindset need to adapt quickly, or you'll find yourself caught in the turbulence ahead. The Federal Reserve is about to make a move that will reverberate across the economy. In just a few days, they are expected to announce the first of what could be many rate cuts. This will not only affect how businesses and consumers borrow, but it will also send a powerful message to investors, economists, and policymakers alike. A new era in monetary policy is upon us. In today's video, we'll dive into 4 essential points. What history tells us about what happens after rate cuts, the economic trends and data driving the need for a rate cut right now, how quickly rates are likely to come down and what that means for you, and which sectors will benefit most, and where you should focus your attention to capitalize on historical trends. Toward the end of the video, we'll be highlighting a specific investment opportunity in the lithium mining sector, which could be particularly compelling in light of the evolving market dynamics. But before we dive into all of this, remember, you are ultimately responsible for your own financial future. Do your due diligence, research thoroughly, and make informed decisions. Let's get started. First, let's take a trip down memory lane. What actually happens when the Federal Reserve begins cutting interest rates? A rate cut isn't just about cheaper borrowing for businesses and consumers. It's a signal, a powerful one. It tells the world that the Federal Reserve is shifting its stance from fighting inflation to stimulating economic growth. Historically, this shift has been profound for markets, economies, and individual portfolios. Take the early 2000s, for example. After the dot-com bubble burst, the Federal Reserve slashed rates aggressively, igniting one of the most significant bull markets in history. Similarly, following the 2008 financial crisis, rates were cut to near zero levels, which jump-started an extended period of growth and stock market gains. The rate cuts helped the economy recover, but more importantly for investors, they provided the fuel for one of the longest bull markets ever. But here's where it gets tricky. The immediate aftermath of a rate cut doesn't always bring instant good news. In fact, many times the market reacts with volatility, and often to the downside. Investors may panic, wondering whether the Fed is cutting rates because of deeper underlying problems in the economy. You might ask yourself, if the Fed is cutting rates, what are they seeing? What are they trying to save us from? Historically, every recession has followed a peak in the federal funds rate. In other words, the Fed often cuts rates too late, and the economy tumbles into a recession shortly thereafter. But once the dust settles, and once those rate cuts start working their magic, the market tends to recover, sometimes explosively. Think of rate cuts as a pendulum. It takes a while for the momentum to shift, but when it does, it can swing back with significant force. While rate cuts are beneficial over the long term, don't be surprised if we see some turbulence in the short term as the market adjusts. The long-term outlook, however, remains bright, especially for key sectors that tend to thrive in lower rate environments. So, why is the Federal Reserve considering rate cuts now? What is happening in the broader economy that justifies such a drastic move? Let's start with GDP growth. Over the last several quarters, we've seen clear signs of the economic deceleration. In the first half of the year, the U.S. economy grew at a modest pace, around 2%, which was slower than expected. This slowdown has persisted for several quarters, indicating that businesses and consumers are pulling back on spending. Let's break this down further. Consumer spending, which makes up nearly 70% of the U.S. economy, has been showing clear signs of strain. Retail sales data over the past few months suggests that consumers are cutting back, particularly on discretionary items like electronics, apparel, and luxury goods. Rising interest rates have hit household budgets hard, and with borrowing costs climbing higher, many consumers are reluctant to take on new debt. The housing market is also feeling the squeeze. Mortgage rates have surged to over 7%, the highest level in decades. As a result, home sales have plummeted, and construction activity has slowed considerably. Data shows a significant drop in housing starts and new building permits, signaling that builders are scaling back due to weak demand. This slowdown is leading to job losses in construction and related industries. At the same time, we're seeing troubling signs in consumer debt. Total credit card debt in the U.S. recently surpassed $1 trillion for the first time ever. Households are increasingly relying on credit to maintain their spending levels, but the rising cost of borrowing is making it harder for them to keep up. Delinquency rates on credit cards are creeping upward, a potential signal of financial distress for millions of households. Business investment has also cooled. Companies are cutting back on capital expenditures and tightening their belts in response to rising interest rates and an uncertain economic outlook. Factory orders, machinery purchases, and new investments are all slowing down, particularly in manufacturing sectors. And while the labor market remains relatively strong on the surface, there are signs of cooling there as well. Job openings have fallen from their peak levels last year, and the pace of job creation has slowed significantly. Recent payroll reports show fewer jobs being added, particularly in technology and finance, which have been hit by rounds of layoffs. Rising unemployment claims are starting to creep higher, suggesting that the job market may not be as strong as it appears. Globally, things aren't much better. China's economy, a key driver of global growth, has slowed dramatically, while Europe is grappling with an energy crisis and persistent inflation. These global headwinds are further weighing on the U.S. economy, particularly in sectors like trade and manufacturing. In short, the economic data paints a picture of a slowing economy, rising debt, and a labor market that is beginning to show cracks. This is why the Federal Reserve feels the need to cut rates. They are hoping to jumpstart the economy and stave off a deeper recession. This brings us to the million-dollar question: how fast will rates go down, and how long will this rate-cutting cycle last? Historically, the Federal Reserve has taken a measured approach to cutting rates. They don't typically slash rates all at once unless there's a severe crisis unfolding. Instead, what we can expect is a series of gradual cuts over the next year, depending on how the economy responds. If we look at previous cycles, the Fed often starts with a modest cut, 25 or 50 basis points, and then monitors the economic data before making additional moves. This allows them to adjust their approach based on the latest information. The goal is to avoid cutting too aggressively, which could reignite inflation or overstimulate the economy. But here's something important to remember. The initial rate cuts can have an inverse effect. When businesses and consumers expect more cuts to come, they may hold off on borrowing, waiting for lower rates in the future. This can lead to a temporary freeze in business lending and consumer spending, exacerbating the economic slowdown. If the economy shows further signs of deterioration, the Fed could ramp up the pace of rate cuts, just as they did during the 2008 financial crisis. On the flip side, if the economy holds steady and inflation stays under control, the cuts may be more spread out over time. It's also worth mentioning the modern wildcard factor. If we see unexpected geopolitical or global events, such as escalating tensions with major trading partners or new global crises, the Federal Reserve could respond with more aggressive cuts to stabilize the economy. Regardless of the pace, one thing is certain: rate cuts are coming and the markets will react. Now, for the part you've probably been waiting for: where should you put your money when rates start coming down? Historically, certain sectors perform better than others in a rate-cutting environment. Here are a few key areas to watch. Technology stocks. Tech companies, especially high-growth firms, tend to thrive in a lower-rate environment. With cheaper borrowing costs, these companies can invest more in innovation, research, and development. Growth stocks, in particular, benefit from lower rates because they rely on external financing to fuel their expansion. Real estate. When the Fed cuts rates, mortgage rates typically fall, making it more affordable for people to buy homes. This can provide a boost to the housing market, which has been struggling under the weight of high interest rates. Real estate investment trusts, REITs, also tend to benefit from lower rates as they can refinance their debt at lower costs. Consumer discretionary. Lower rates mean more disposable income for consumers as borrowing becomes cheaper. This often leads to increased spending on non-essential items like travel, entertainment, and luxury goods. Companies in the consumer discretionary sector could see a boost as consumers loosen their belts. Commodities and precious metals. When the Fed cuts rates, the value of the US dollar often weakens, which can boost the prices of commodities like gold and silver. If you're looking for a hedge against market volatility, adding some exposure to precious metals might be worth considering. That said, rate cuts are not a time to make snap decisions or chase every hot stock. The key, if you enjoyed this, don't forget to like, comment, and subscribe. Your support means the world, and it helps us keep bringing you more great content. Plus, I'd love to hear your thoughts. Drop a comment below.